Einar Tangen. He's a senior fellow at the Taihe Institute and chairman of Asia Narratives. Welcome back to the programme, Einar. Now, why is the central bank still holding rates steady despite clear signs of slowing growth?
Well, right now, they've indicated that they are going to do what was necessary, but I think they're doing a wait and see. It's really a sense that they wouldn't be doing this unless they had confidence in what they're doing. So they believe that there's going to be delay in the actual data that comes out and that it will, in fact, improve. Also, just cutting interest rates, they don't believe is going to be it. I expect that there will be a fiscal and monetary policy response, especially coming up in the new year. And I think most people would agree with that.
Right, and growth is still on track to meet this year's target, yet recent data shows slowing factory output, weaker retail sales and soft household borrowing. How concerned should policymakers be about domestic demand heading into the new year?
Well, domestic demand is the number one priority. But as I said, I mean, the Chinese government is very deliberate. If they thought that it was time to hit the emergency bells, they would. Obviously, they think that things are going to improve. They're pretty certain that they're going to be on track for this year, and it's a holding pattern. We all understand that we don't know what's going to happen with Donald Trump. We have a lot of turmoil internationally, and China is just staying the course. Panicking at this point would not help confidence in the economy itself. They're really trying to figure out how they can stimulate. And like I said, it'll probably be a joint package, a 1-2 punch, where both fiscal and monetary policy is involved. So expect, as I said, early in next year, I would expect that there will be, in fact, some rate cuts. And on top of that, some stimulus measures. It's not clear how they're going to do that. I don't think it's going to be the same pattern that they used before of actually trying to just, offer rebates on more consumer goods. I would expect that they're going to try to have more direct stimulus. They've indicated that they want value for money. And as I said, very deliberate.
Right, and China's trade surplus has crossed the $1 trillion mark, but as you mentioned, exporters are facing a tougher global environment. How much can China rely on exports to support growth in 2026?
Well, they're trying to move away from it, but you have to understand the relationship between exports and the domestic economy. A lot of what China has achieved is in terms of lowering prices, and a lot of this depends on volume. So to the extent that they're able to use international markets to keep competition going without necessarily cannibalizing necessary industries, they want to push that, because what that means is that when Chinese consumers start consuming, they're pretty much assured that they're getting the lowest prices out there, and it will be very good for Chinese manufacturers. Now, this is all the bet, but right now we're faced with a lot of political doubt, uncertainty. Things are heating up. Tankers are being seized and things like this. And I really do believe the Chinese government is waiting to see how much damage is going to be done. The sales in the United States were actually up for Black Friday. That was a good sign. Unfortunately, a lot of that was due to people borrowing, literally buy now, pay later, which means they're going to pay more later, up to 30%. So things are uncertain right now. The only thing that they know is that they don't want to panic, and they want to get as much value as they can from their monetary and fiscal stimulus.
All right, we'll leave it there for now. Einar Tangen in Beijing, thank you very much for your insights.